The market today is what I like to say a nobody's market, and it's been that way for a while. People often argue, is it a buyer's market? Is it a seller's market? I really feel like it's a nobody's market because if you talk to people who are trying to sell a deal, they're unhappy. And if you talk to people who are trying to buy deals, they're also unhappy.
In this episode, I talk with Rob Beardsley. Rob is a founding partner of Lone Star Capital and a seasoned multifamily investor who has successfully acquired over $350 million worth of multifamily properties. We discussed how Rob went from a college student to a multifamily investor, how he closed his first deal, a 270 unit property at the age of 21, all the challenges that he had to overcome to get that first deal closed, the current market conditions and future market outlook, and so much more. If you're a young real estate investor or you're looking to get your first multifamily deal done, you're especially going to enjoy this episode. So let's get started with the show. How's it going, Rob?
Going well. Thanks for having me on the show.
Absolutely. Thanks for coming on. Looking sharp. You actually might be the sharpest dressed guest I've ever had in this show.
Beautiful.
Yeah. Which you're in the New York market, right?
Yes.
Okay, so very fitting. New York City?
Yep. Downtown. Yeah.
Okay, so makes sense. So you're in the multifamily space, and we had a chance to get together for dinner a few weeks back when you were in Houston. And how old are you?
26.
26. All right. Pretty young, ambitious, and you've done quite a bit in a few short years. So how did you find yourself in the multifamily space?
I grew up in a real estate family. My parents ran a residential brokerage firm back in California. So I was exposed to the real estate business. They also did some construction and some flips on single family homes. And I went to school for computer science, thinking I would maybe get into tech, but eventually circled my way back to real estate, the best business in the world. And I discovered multifamily just online through research, Bigger Pockets, podcasts, YouTube videos. And I really felt that multifamily was a fantastic business model. So I just kind of took it one step at a time, joined a mentorship group. I tried to get my parents more involved, and they were just too busy with their main brokerage business to go all in. So I was fortunate enough to meet my business partner, and we were able to form Lone Star Capital together to focus on Texas workforce housing.
Nice. So you computer science, which I actually wanted to do that in high school. That's why I thought I was going to go in, be a computer scientist and build apps and all that. So was it you just like going through those motions and you're like, man, I really don't want to do this? Or was it, hey, this is cool, this is fun, but hey, this is cool too, let me try it, and now I like this better?
Yeah, well, I really enjoyed school, and I really enjoyed my studies in computer science and all that stuff. But when I had this opportunity to start this multifamily business and go out and do deals, it was very compelling, and I just felt that it was the most optimal route for me to take to build a successful business. And I've always been entrepreneurial minded, so taking that leap of faith and dropping out of college didn't seem like the biggest risks to me, because I felt like if I failed, I could always go back to school, and there would always be other opportunities for me. But there was no reason to pass up the opportunity I had at the time, which it turned out to be true. And the experience that I gained in those early years was worth 10 times the amount of education.
And was that opportunity an actual multifamily deal, or was it more just you were exploring just starting your business?
Both. Both. I mean, we were obviously looking to do deals, and we were hunting and talking to brokers and lenders and familiarizing ourselves with the business and property management, and talking to investors and just immersing ourselves in the business model. And before you know it, we had put our first deal under contract, and then it was full speed ahead.
How many units was that first deal?
It was 260 units.
260 units. And how old were you at the time?
I was 21.
That's awesome. I'm gonna get back to that. Let's go back to the dropping out of college. So you had to tell your parents at some point. How did they take that?
They were pretty understanding, I would say, considering the circumstances. The My parents have always been really supportive in everything that I've done, which has been a huge benefit to my life. And so walking them through the pros and cons, and telling them that my advisor was essentially advising me on this course of action, it was I didn't get a lot of pushback. I did, however, basically have to deal with the reality of, okay, you're currently a college kid who is lucky enough to have his life and expenses covered, and you get to just have the low stress life of the only thing that matters are grades and homework and tests, right? Which is a pretty
Things are
easy
pretty
life.
simple then.
Pretty simple, yeah. To All right, if you're going to drop out, well, then your life is not covered. You're on your own. That's your decision, and so
Yeah,
you're
it's
going
real
to go
life.
from to real life. You're going to go from a cushy life to the real life much faster. So there is some. My dad always, I mean, he certainly pushed my sister and I to work hard and be successful, but he also recognized that there was always more time to be an adult in the future. And so he didn't necessarily rush us to become adults per se, but I've always been very mature and always enjoyed looking forward to the next step. So for me, giving up that, kid college life and experience, I didn't go to a single college party at my university. I was either immersed in studies or I was working on building this business, and then I left school. And so I didn't mind kind of getting to the next phase. It's always just been following my passions and my drive.
Yeah, I love it. I mean, I thought I was unique when I did 4 deals in college, and back in 2004, 2005, it definitely was. And here you are, you got 270. All right, so how did you really take that deal down? How did you find the deal? How did you take it down? Because it's one thing to buy a single family house, which there's a lot of resources where even someone inexperienced without a lot of liquidity can take that down. Um, it's a totally different ball game to do 270 units. There's more to it. So walk us through that.
Yeah. So as you could imagine, there was a lot that we didn't know. And so we were naive enough and had the confidence to just put the deal under contract and take it from there, right? Take it as it comes. And so we fast tracked ourselves to learning all about debt and realizing that, oh, you need to have a certain net worth and liquidity requirements, which we don't have. So we're going to need a loan guarantor. Okay, well, how do we find a loan guarantor? What's it going to cost to bring them into the deal? What are the nuances there? And then on the equity side, we had really had by far the hardest time on the equity, because both my business partner and I fell into the trap of believing that if you find a good deal, the money will come. And that simply is not true. Because even though we had a great deal, we didn't have track record, we didn't have relationships. So that made it really, really difficult to raise equity. And so we spent the majority of our time trying to find partners, find investors, do whatever we could to close the deal from an equity perspective. So that was the biggest struggle, and somewhat of a wake up call, and a very, very stressful situation. And the interesting thing is raising equity on its own is very difficult. And even for us today, it's still a lot of work, even though that, the numbers have grown exponentially and we have so many more relationships. But it is still challenging. But on your first deal, it's even more difficult. And then we compounded that problem by not having everything else in place, right? Like I mentioned, we didn't have the loan guarantor situation sorted out. We were kind of bouncing around between different property managers. So everything was so disorganized, which is exactly what you don't want going on in an escrow, because time is of the essence, right? You have the luxury of time when you're out of contract. Once you're in contract, time moves very quickly, and you want to have as few outstanding items and variables as possible. So those were, some of the big mistakes that we made just because we didn't know any better.
Yeah, I don't know why it just flashed me. It's almost like Lord of the Rings or whatever. I'm not a huge Lord of the Rings fan, but I've seen the movies, and like you're on this journey where like yeah you're just going to take on the world, but now there's all these challenges coming at you, just trying to crush you along the way, and just figuring it out as you get along to accomplish the mission. Let's start with that earnest money because earnest money for a single family house. Most of them I can buy, no earnest money. And almost all the 200 flips that we've done probably didn't put any earnest money down. A little different from multifamily. Did you raise that? Did you bring a partner in for that, or did you have the cash on hand? Because 207 units, that's it's a sizable amount.
No, yeah, for sure. So that's another good point that I forgot to mention. Yeah, earnest money is another element of the deal that you need to have organized and taken care of. So us, fortunately, we were able to borrow money from family members with a personal guarantee in order to put the money down on earnest. So essentially, we were out risking money that we didn't have to close a deal that we need to go raise capital for. So really, we put our backs against the wall and took a lot of risk. And looking back on it, you kind of look at it and go, wow, that was a lot of risk that we took. But I think it's really valuable to have those moments in your experience in your career because it really forces you to grow the most and the fastest, right? If you are working out in the gym without a trainer, you're not going to work as hard if you have someone pushing you. And in this case, we had money pushing us, and the risk of losing money and the risk of really tarnishing our reputation before we even got our business off the ground. So really, there was no chance of failure. We could not let ourselves fail. And so putting ourselves in situations like that where failure is not an option essentially, I think is actually a really great way to get where you want to go faster.
So, all right, so you borrowed the money from family for the EM. And now you're trying to raise. You're getting a loan, looking for a loan guarantor partner. Did you bring on an operating partner as well to solve that problem for the equity investors?
So we, in the end, partnered with a group that signed on the loan to satisfy those requirements, as well as brought the management company to the table and the operating expertise.
Yeah.
So, and I think that's a very smart way to go, is obviously bringing partners in to rely on other people's assets, such as their track record or their experience or their infrastructure, their team, for the execution of the business plan. And yeah, so that's what we did, and it was a very rough experience. And the problem with what we did was we scrambled, and we didn't find this partner when we weren't under contract, when we had the luxury of time. Instead, we scrambled and had to find somebody last minute, and that meant that there was a higher chance of us not being with the right partner. And in the end, we were not with the right partner in that case. And so we had to make moves after closing to change partnership and move on. And this experience actually pushed us in the direction of vertically integrating and bringing property management in-house on a much quicker timeline than what most firms on that track do. So we actually brought property management in-house 2 years ago now, and it's just been a fantastic experience. And we really are grateful for the business that we're building, and that we have more control and transparency in our organization.
You almost have to if you're going to be have any reasonable density within a marketplace. It just makes sense. I mean, if you're spread out across multiple markets, maybe not, but that makes sense. Now, in the beginning, did it come across your mind to, hey, we could bring on a partner, but maybe let's not, and let's do it ourselves? So we'll, protecting your equity, protecting your portion. Was that a debate, and then you figured out later on, hey, we really need to bring someone else on to solve this experience problem? How did you see that from the very beginning versus what actually happened?
Yeah, I think you're absolutely right. We we're ambitious and wanted to do as much as we could on our own. But with that being said, I did have this belief in my mind that I held on to as we went through the process, which is it doesn't matter how many pieces of the deal we have to give away. It doesn't matter in the end how much money we make from this deal. The important part is getting the first one done. And keeping that in mind kind of kept us sane as we were bringing on partners and getting negotiated against ourselves and having to give up more of the pie than we wanted to. But in the end, like I said, we stayed the course because we knew that the bigger picture was what was important.
Yeah. And I think the last part's very true. It's not so much that it doesn't matter, is it does matter. I mean, there's money at stake, but there's other things at stake. And that's what the more important part is that you got to. I went through the same thing. Like when my wife and I bought our first multifamily, it was a small 29 unit. And it was I had done 4 deals in college, fast forward time. Now we're buying houses. So this is together between the two of us. This is our fourth deal. And we both had jobs, baby on the way. And I take this $500,000 hard money loan to buy this dilapidated 29 unit. And it was going to be this monstrous project management that I was going to deal with, along with a full-time job and all this stuff. But I went lone gunman because I could do it. But I think you can relate to this. I didn't know what I didn't know. And long story short, I went to go refi, and all the due diligence I did didn't matter because they were like, "Oh, okay, well, yeah, you don't have experience with multifamily, so love your single family experience, no multifamily experience. Sorry, couldn't refi." And long story short, we sold it, made a good profit, but it was a fraction of what we could have made if we brought on a partner. And being greedy ended up costing me money. And the cherry on top of this is the hard money lender I'm friends with. At the very end, I told him all the back end stuff. He knew what was going on, but I told him the back end stuff, and he goes, "Oh, should have just asked me. I would have partnered with you." I'm like, "Son of a, don't tell me that." So that's good. So now you got your first deal under the belt, and you realize like this huge thing that you were able to overcome, all these challenges that you didn't foresee, or maybe you thought about but didn't think it was necessary to take on partners winner. But you got this first deal done. Looking back, if you could go back and if you could give a syndicator right now or aspiring multifamily investor looking to get in, how would you suggest they approach that first deal?
Yeah, there's so much advice that I would love to give. And so based on my experience, what I would advise is to lay as much groundwork as you can before you're actually under contract and staring down that first deal, because there's no reason why you can't line up your loan guarantor before you've identified an opportunity. Right? By the time you've identified a deal, it's too late to find a loan guarantor. It takes time to build relationships and build trust. And that is really, really valuable because that will allow you to focus on other things, primarily raising equity while you're under contract rather than scrambling for a loan guarantor. So that's one of the things I would have lined up. I would make sure to have your earnest money lined up, your loan guarantor lined up, your property management team lined up, whether you're going to use a third party or partner with a co-sponsor or something like that. You really want to have everything lined up to minimize the amount of variables once under contract.
Love it. So right now, what asset class and strategy are you primarily using in multifamily?
So today our company is exclusively focused on Dallas and Houston. Mm-hmm. Workforce housing, which we define as deals built in kind of the 80s to the 2000s and are in need of some sort of value add, whether it be improved management, renovations to the interiors to raise rents, and cleaning up deferred maintenance. So that's our bread and butter deal, whether it be, like I said, in Dallas or Houston. And then more recently, we've been also focusing on an affordable housing strategy, which is very unique and interesting, that I like a lot given the current uncertain market conditions, where it may not make sense economically or risk-wise to be buying assets and trying to push rents even further because affordability is tight. And if we do go into a recession, it's going to just be even harder for residents to be able to afford rental premiums. So I do feel like a defensive strategy where the focus is on preserving affordability rather than pushing rents is really a good fit in today's environment.
Yeah, and I think that has a small component to the current like the package deal you're working on right now, because it's in a program to where there's tax deferred or it's tax exempt for having affordable housing units a part of the community, right?
That's right. Yeah, and the affordable world is so interesting, and I think we're going to go even further into it as we build our experience. And I think our team is really well suited for the affordable housing world because it is more complicated. It's more nuanced. But it takes time to build relationships. But once you kind of get into the affordable housing space, you see people once they get in, they never leave, and they make a lot of money. It's a very lucrative space. So we want to only grow our experience. There's so many different programs to be familiar with, and it's different in every market. So it's a fascinating space. And like I said, I think our team is well suited, just given our expertise. My business partner is a tax attorney. We're quite sophisticated. So I think we are well suited for it.
Okay. And is that the primary way you're looking to mitigate risk going forward, or is there some other things you're looking to do?
Well, generally speaking, we are focused, at least for now, exclusively on long-term fixed rate debt, which is really, in my opinion, the best way to mitigate risk. There is some controversy surrounding that strategy because a lot of people are calling for using floating rate debt today to hopefully benefit from rates drifting lower in the future, which I don't disagree that that's definitely a viable strategy, but the certainty of your cash flow is just worth so much, even if in the end you end up paying a little more interest for that certainty because of the timing with which you lock your interest rate, right? You're going to, over the cycle, you might have a fixed interest rate at a higher rate and then other deals at a lower rate. It'll all work out over time if you're just consistently investing for the long term.
And is that fixed over a 5 or 10 year period, or are you fixing for longer? Because there's like for those that don't know, in single family fixed rate, you sell. 30-year fixed, and you sell in 5 years, no big deal. You get a payoff quote. Typically, unless it's a like a non-QM type loan, if it's conventional, there's really no fees to that typically. But in commercial, different ball game. Like you said, you want a 30-year fixed, they're going to hold you to that, and there's going to be a lot of penalties and defeasance and whatnot. So, how are you baking that into the pie? And kind of walk me through that.
Yeah. So right now, the strategy is to do 7-year loans with a 5-year yield maintenance period.
Okay.
And that gives us, in our opinion, the optimal long-term conservative loan coupled with flexibility.
Yeah. So if you have to sell, if an opportunity to sell sooner works out, it's not that big of a hit. But if you need to hold on, you've got the surety of what your debt cost is.
Right. And the full 7 years is quite a long time to ride out a potential downturn or something like that. And then, given the 5-year yield maintenance, if we sell in 5 years, which is our typical pro forma, we would pay no penalty to exit, which is really nice.
Yeah. Okay. How do you see the market playing out over the next 12 to 18 months? How is it now? How is it now? Because I'm sure you're putting out a lot of offers and you're talking with a lot of brokers. So what's the sentiment now, and how do you see that changing or evolving over the next 12 to 18 months?
So the market today is what I like to say a nobody's market, and it's been that way for a while. People often argue, is it a buyer's market or is it a seller's market? I really feel like it's a nobody's market, because if you talk to people who are trying to sell a deal, they're unhappy. And if you talk to people who are trying to buy deals, they're also unhappy. And essentially what we have is a very wide bid to ask gap in the market, which is resulting in very few deals actually getting done, because Generally speaking, you have sellers with pricing expectations up here and buyers with pricing expectations down here.
Like who's going to blink?
Yeah. And that's exactly right. And that pricing adjustment process doesn't happen overnight. Just because interest rates have gone up and the market has changed, cap rates have gone up, that doesn't mean sellers are willing to recognize a change in the value of their asset or even a loss overnight. It's going to take a lot of time for sellers to capitulate and maybe become forced sellers due to their debt structure or due to their declining operations potentially. So I do think certainly over the next 12 months, we're going to see a resolution to this nobody's market, and the bid to ask gap will tighten enough to the point where we're going to see a decent resumption of transaction volume. Because right now there's not many deals getting done, and that's not fun for anyone. So I'm optimistic that towards the end of 2023, we'll really see that gap being bridged.
Do you think most of that is going to come from operators under bridge and or floating rate debt?
Yeah, I think that's going to be a driver for sure.
Yeah, 'cause at the end of the day, if interest rates are at a point where you can't, if you're in bridge and you can't refinance, I mean, you can't meet the debt coverage ratios to refinance, put you in a bind. You either got to raise more money, do a capital call, or you got to sell. But there's also folks that may have longer term loans that are floating rates, and that puts pressure on them.
Yeah, and I think it takes a long time for an owner and in particular a sponsor to want to get to that point where they are essentially fire selling or selling not necessarily at a loss, but just not meeting their business plan. Especially for a sponsor, it's to their benefit to do whatever they can to extend the loan or make a capital call. As negative as a capital call is, it's better than selling for a loss. So for those that are sitting on the sidelines, hoping and waiting for all these distressed deals to come to the market and be able to pick off buyers who are distressed, I don't really think it's going to happen. I think there's a lot of liquidity out there, and there's a lot of time as well. And so the gaps in the capital structure can be bridged through preferred equity, through capital calls, through third party, rescue capital of sorts. So rather than a bunch of people flooding the market, selling deals at a discount, I think there's going to be a lot of restructuring plays and things like that. And then after a while, couple years of people trying these certain restructurings and buying more time, then eventually someone may capitulate and say, all right, we've tried everything. We just need to sell. We'll break even or we'll take a loss, what have you. And that's what I think may occur in the next couple of years.
Yeah. There's another scenario too. And it's the writing may be on the wall, but either due to inexperience or blinders, they're not quite seeing it. And as things play out, eventually it's the head in the sand kind of scenario. I mean, I saw that in the single family space. Wasn't following multifamily at all in the crash, like the 08 and the years following that. But I'd imagine it's just human psychology. At some point that may happen. Probably very rare occasion, hopefully, but especially for their investors. But now I mean, on the other side of it, you also have investors that they've locked in 7 years at 3%. So do they need to sell now, even though their business plan might have them? Maybe, maybe not. It really depends on what their investor base is, but they definitely have more flexibility to write out uncertainty to see what happens over the next year or so, like see if rates drop. So yeah, it's going to be interesting.
Yeah, and that's the magic of long-term fixed rate debt. There's a lot of people that have done that and are sitting pretty and they're able to sleep well at night. And that is a very beautiful thing.
Love it. Love it. Well, there are a couple questions I ask every guest on the show. So I'm going to start here, kind of closing out. If you could give advice, we may have already covered this one, and feel free to backtrack the age here. But if you can give advice to your 20-year-old self, what would that be? I don't know. Maybe you want to back it up to 15. I'll let you answer the question how you will.
Yeah, no, it's always a good question to think about. I would say, so for me to kind of stay on topic, I would say I was a bit late to the game, which obviously it's all relative, but I had limiting beliefs and blind spots related to marketing, sales, and raising equity. So I kind of grew up with this notion that marketing was gimmicky and that sales was a bad practice, or or like salesy was a bad thing, right? So because I had those beliefs, I really didn't like sales and marketing, and I didn't think that it was important. And like I told you, I subscribed to the myth that if you find a good deal, the money will come. So I told myself, all right, well, I'll just focus all my time on finding good deals, and then the money will magically appear. So I would definitely tell my 20-year-old self to go all in, to the contrary, all in on building a brand, doing thought leadership, and establishing investor relationships as early as possible, because it takes a lot of time to build up those relationships in this business. You can't build that overnight. So starting as early as possible is hugely beneficial.
Love it. What book or books have greatly influenced your life?
Well, to take it in a different direction, the Power of Now is a really interesting book that was very important to me, because it kind of opened the door to my path of meditation and being present to the moment. And it was very transformational in my own way. So something that we could talk about maybe on another time. But yeah, The Power of Now is a really cool kind of, self-help woo-woo book that is not at all to do with business. So that's a great one. And then business-wise, I really like Getting More by Professor Stuart Diamond. We actually had Professor Stuart Diamond come and give a half-day negotiation workshop at one of our events a couple years ago. So that was really amazing, given the fact that I had read his book so many times. But spending time to learn the skills of negotiation, and similarly disabusing yourself of the myth that negotiation is this, me versus you adversarial thing, is really helpful, because it doesn't have to be that way. It's actually about how we can all get more.
Yeah, love it. And those are two new books. I had the opportunity to go to a class with Chris Voss. It was a 2-day workshop and on negotiation too. So yeah, it's incredible. It's a skill that really, it definitely impacts your business life if you're in business, but you can use it anywhere. In the last 5 years, what new belief, behavior, or habit has most improved your life?
Journaling, writing down gratitude, writing down my goals, and really spending the time to brainstorm ideas, strategies, and how to achieve my goals. And then also correlating those goals to daily habits and daily routines and tasks that need to be accomplished in the here and now. So many people, I mean, if you're listening to this podcast, you're already probably more of a successful person, more results oriented. You probably already have goals, but there's so many people out there that don't even have goals. They don't really know what they want. And the power of getting really specific with what you want and your goals, and setting quantifiable, time oriented goals already puts you on a fast track to achieving them, because it will just get your brain thinking about how to get there.
And writing them down has a compounding effect on the result of, or the ability to actually achieve them.
Yes, love that.
How can people reach out to you?
You can find out more about us at Lone Star Capital on our website, lscre.com. You can also connect with me and shoot me a message on LinkedIn. I post daily videos and posts on LinkedIn, so feel free to connect with me there as well.
Thanks for tuning in. If you got any value out of this at all, please like, comment, subscribe, follow. I'd love to hear from you. And for more real estate related content, market observations, upcoming events, you can go to investedx.com and subscribe to our weekly newsletter. I promise you won't regret it. Thanks again.